course gets a little bit more intense and where you really need to be paying attention. All right? So please tell your classmates this is not the time to miss in classes. Okay? Remember, one of the things you need to keep in mind is that it's not a midterm per se, right? Your take home is 10%, then you have your individual assignments, all right? Which is more, okay? You need to be paying attention, and then the weight of it is on your exam. Fortunately, this one is a 40-60, so your exam is 60%. Point I'm making is, when you see that exam paper, it'll be the first time you're really seeing the exam, right?
We can
what I try to do is in the take home, I try to give questions like the exam. So with the take home, you have the opportunity to do your research and see what the exam type questions would be like. I believe I may have shared in the past, some past papers, well, what my exams that I would have given previously in this course, right? So I will do that again so that you have a sense of the types of questions. Now, please don't take this course lightly.
was just about it.
Please do not take the course lightly, all right? Because it is not a course where you're going to give me the answers straight out of the text. It's application of what you're learning to every day, what you are seeing today. So last week we would have spoken about Trump and what did we talk about Trump and his policies and how that is affecting the world and so on, all right? There was an article I read and I thought that it was a good article to share. I saw it in the paper, but unfortunately, because my phone internal memory is at 98%. And so I've been trying to just delete as things come and delete that. So I've been deleting the newspapers, but this is an article that was written in the paper by Ronald Saunders. I think it was sometime last week, and I was to have written down the information since my brain is not as young as it used to be. But anyways, so we will try to incorporate those things in our discussion so that when exam comes and you get questions that relate to what's happening today, you can use them. All right? I was going through an old, just this morning I was going through my old Moodle for the course when I taught it in 2022. Is it 22 or 23? Maybe 23, it would have been 23. And I'm like, this is a nice homework assignment to give the class. So anyway, that said, let's do a little revision from last week. So last week, what did we discuss? What did we talk about? Foreign exchange, the foreign exchange market. What about it? I'm not supposed to be what's that? It automatically pulled up my, okay, good, it didn't warm up yet. I had my email on my screen.
Okay.
The foreign exchange market. What about the foreign exchange market? What did we discuss about foreign exchange market? It's a good thing I just had breakfast. I don't do something muffin. It's all right. What about the foreign exchange market? Not all at once, put up your hand. Go ahead, Rachel. Buy and sell currencies, Nikisha.
I was going to say that what happens between firms, individuals, and businesses.
Firms, individuals, businesses, okay, good. Anything else about the foreign exchange market? Okay, y'all don't remember, so let's get more specific. So when we talk about foreign exchange, we have to always reference one currency in relation to the other, right? So when we are quoting foreign exchange rates, how are they quoted? Well, what's the terminology we use when you quote one rate to another? The direct quote. What is a direct quote? How does that look? So, how does a direct quote look? So if you had an EC dollar, and we go into the US, what would this be? What? This would be the USD, but what?
Foreign currency, 270, I guess.
One EC dollar.
Is it domestic? Is it You want to go to the US? 0.37 USD.
0.37. Okay, so it's EC to US, right? Because one EC dollar is going to give you.
Do you have to put that dollar
That's,
sign
I mean-
in front of the 0.37? No.
Generally no, but if you're generally no, it depends on how the question is asked. So if you had US to EC, what would it be?
That's the indirect quote.
Okay.
That's the indirect quote now, below. Oh, no.
So how does the indirect quote look?
I believe it's the second one, right? How much US you would get for EC? Right? Something like that.
How does the indirect quote look?
How much of the foreign currency?
It would be the opposite, so it would be 1 over 0.7, right? But we'll come back to that. Did you do any, in tutorial, did you do any calculations?
Yes.
All right, so what kind of calculations you did? You did the cross rate, and you did straight, direct, indirect. Okay. All right, good. So we talked about direct quotes and indirect quotes. What's the cross rate?
It's where you use more than one currency.
Where you use more than one currency.
Where the third one is usually US.
The third one is not always US, but yes.
Usually, yeah.
All right, because the US currency is the currency that most countries relate to. Okay? All right. So currencies appreciate and depreciate. So that produces what for firms and individuals? Foreign exchange risk.
Currency risk.
Right? So foreign exchange risk, what is foreign exchange risk? See if you can verbalize that. What is foreign exchange risk? Potential loss or gain when currency fluctuates. All right? All right, great. So, never mind, let me not ask that question. What are the methods that are used to reduce foreign exchange risk or exposure? Hedging, okay? Hedging and what? Speculation.
Forwards, futures.
So in hedging, we use forwards, futures, and
Options.
options, right? Within the market, You exchange currencies because you need to do business. However, there are some persons in the market that use it for speculation. All right? Okay. What is a spot foreign exchange transaction? Huh?
The immediate purchase.
Immediate
Buying-
sale or
buying-
purchase, yes. All right?
I see.
And the forward is purchase, purchase for a future date, but you're fixing the currency, you're fixing the rate today. All right? Okay. What is an FX or foreign exchange forward contract? What is that? Is that a foreign exchange forward contract? What does that mean?
Well, it's an agreement between two parties to
Between two parties, yes?
that we'll perform a transaction.
You would perform a foreign exchange transaction,
Based,
yes?
based on the rate today, basically. Based on the rate,
In
I
the
think,
future, based
on
on
the
the
future.
rates agreed upon
from today, yeah.
All right?
Okay.
Okay, good. How is that different from a futures contract?
Yeah, that's it.
Somebody is going. How is a forward contract different from a futures contract?
Should we explain it?
Anybody? Go ahead, Richard.
From what I know, if a few currencies are involved and they have specific dates when you can do transactions.
All right, what else do you know about the futures? That's it? All right. Okay, I did not, what I do when I'm teaching the forwards and futures, instead of, if you check your text, there's a chapter that speaks purely about forwards, futures, options, right? What I like to do is, rather than teach it from that chapter, I teach it by application, right, of what we're going to be doing today. So to me, you understand it a little better. All right, so basically a futures contract with a forward contract is a contract between two people. All right?
Mm-hmm.
With a futures contract, it's two persons, we can arrange to do our transaction. We have no middleman. All right? With a futures contract, there's a middleman. There's an exchange involved. All right? And then, like Rachel said, there's specific currencies, and the futures contracts are done in specific in denominations. So, sterling futures contract, one future is maybe 100,000 sterling, right? Whereas in another currency, it might be $1 million. So they are fixed amounts, right? So instead of, so let's say it was a 10 million US sterling contract, right? You're going to have to, if it's 10 million and the contract size is 100,000, the futures contract size is 100,000, then you're going to have to divide the 10 million by the 100,000 to know how many futures contracts you need. All right, but we'll discuss it after in a little bit more detail, but I want to introduce it as an application. All right? So with the futures and exchanges involved, you have to have an account with a broker, and the broker is going to do the trading for you. But we're not going to get into that right now. Okay? What is a foreign exchange options contract? What's an options contract? It's similar to a futures, but it's a right but not the obligation to purchase an underlying asset. The important thing between futures, options, forwards, they all have an underlying asset, right? So right now we're using foreign exchange futures, but you have futures in stocks, in bonds, in commodities, all right? Right, so today, and I would have only just posted the slides this morning. Today we're going to be talking about managing foreign exchange exposure, all right? We're going to be looking at how firms manage foreign exchange exposure. If by chance you had the time to take a glance at it, you'll notice, first of all, is technically 18 slides, right? But it packs a lot of information. And so we may not get through all of this today, so this will go over to next week, all right? It will take us 2 to 3 weeks to finish the discussion on this topic, all right? Managing foreign exchange exposure. While at the same time, you will be learning how futures, forward, and option contracts work. All right? Okay. So, like I said, you need to be engaged. All right? You will have homework assignments to do. All right? Of course, you'll practice in tutorial, but you're going to have some homework which I will post on Moodle. Okay? Right, so, and of course we'll do the examples in class as well. Okay, even though you're going to have your tutorial session, we'll do examples in class. So, one of the things we know, if you're a multinational firm, it means you have a factory, or your head office in one country, you have a factory in another country, or you are purchasing your inputs from another country in different currencies, right? And so as a multinational firm or international financial institution, as I have there, you are exposed to changes in interest rates, right? And so the changes in the interest rates is going to expose the firm to what?
Loss.
To risk or loss, yes? Okay? Potential risk or loss. Now for a multinational firm, they can identify a few areas where they are exposed, where that exposure comes from. So the first one we want to talk about is exposure from transactions. Transactions, they purchase goods, they purchase services, so that you get the exposure from transactions, right? Just doing transactions. Then as a multinational firm, you are going to be exposed to economic exposure as well. What is that? We'll discuss each of them separately. The third source is translation exposure, right? So you have transaction exposure, which is the most popular, which is quite obvious, but you have the economic and the translation, which is not as obvious, but it happens, right? So with the transaction exposure, all right, the company, like I said, obviously is exposed to changes in rates on a daily basis because they are doing business, all right? They are wiring funds, they are purchasing. The transaction exposure arises out of their normal operations, okay? So that's how you can look at it. Transaction exposure arises out of normal operations. Then the economic exposure has to do with how the value of their firm is affected when interest rates change. All right? Economic exposure is the extent to which the value of the firm would be affected by unanticipated change in exchange rates. So when we talk about the value of the firm, what do you think we're talking about? Huh? How profitable it is,
Share,
okay?
maybe share price and all
The
that.
share price, yes. Okay? And the value of the firm, if the firm is resident in China, right? And the Chinese yuan is fluctuating because of economic conditions in China, then obviously the value of the firm's assets, everything on the firm's balance sheet will be affected by that, right? And so it's not that the currency itself is fluctuating, but because of changes in the economy. If the economy in China is bad, then the firm is affected because the firm's profits are going to be lower, and so on, right? Translation exposure comes from where you have a multinational corporation and they have, it's a multinational corporation, so the head office may be in the United States, but they may have a subsidiary in the UK. They may have one in Europe. They may have one in the Caribbean. All right? Let's say they have one in Antigua. Anybody can think about what sort of company may have that situation? What kind of company may have a situation like that? That you can think of. Huh?
Franchises.
Franchises? Okay, maybe I need to be a little clearer. So, Bank of Nova Scotia. Not so long ago that Bank of Nova Scotia was in the Caribbean. In fact, they're still in the Caribbean because they still exist in Jamaica, they still exist in Barbados, right? Now, Bank of Nova Scotia, depending on the arrangement, if it was a subsidiary as opposed to a branch, and even with the branch, Bank of Nova Scotia is in Canada. Bank of Nova Scotia would have a presence in England because it's an international bank, right? So the regulatory rules in Canada would require that they consolidate their financial statements. All right? So you have the head office, you have the subsidiary in London, you have the Banks of Nova Scotia branches in the Caribbean. You have one in Barbados, you have one in Jamaica, right? So Bank of Nova Scotia is exposed to how many different currencies there? Jamaican, Bajan, sterling, all right? And so when they have to consolidate their statements, they have to convert to Canadian. Now there are rules about conversion, when you do it, how you do it. And we'll learn that in translation exposure. So the translation exposure is the chance that a company's financial statements will be affected by changes in interest rates. All right? Because the reporting currency in the home country is the currency in the home country. Now, Bank of Nova Scotia in England or in New York or the US, they also, because they're operating in a jurisdiction, they have to produce financial statements, and so their financial statements are going to be produced in the country of residence where they physically are. So that is how now they have to convert head office has to now convert the statements from each subsidiary to that home currency. So there are regulatory requirements that require this, all right? And then the accounting standards also have some requirements. So we're going to look at that, okay? So all foreign currency transactions will expose a financial institution to transaction exposure because you have to convert your contracts in foreign currencies to the domestic currency. It doesn't have to be right away, but at some point you have to do that. All right? So a financial institution will have payables, it will have receivables denominated in foreign currency. Not just a financial institution, but any multinational company will have payables and receivables denominated in foreign currency. And so they are going to experience foreign currency exposure, not just from the currency, but from interest rates as well.
Okay.
All right? And so the financial institution or the multinational firm, we're using them interchangeably, attempts to reduce their exposure by hedging. All right? And so we're focusing now on transaction exposure. So any transaction, any movement of funds, all right? The techniques they use, hedging, and we're going to identify what the techniques are, and then we're going to, we'll see the examples for that, right?
Yes.
Good morning. So, there are financial contracts that they use to hedge, all right? And the financial contracts are the ones we would have identified: forward contracts, futures contracts, option contracts, swap contracts, and one that we did not talk about, but we didn't talk about swaps either. One we didn't talk about is money market instruments. And we're gonna see how that works, right? We'll look at how institutions utilize the money market to hedge their exposure. What's the money market? Short-term securities. That's a sold, yes. Okay? Now, anybody in here doing management and finance?
Accounting and finance.
Okay, I have a couple management and finance, and so you may not have seen, if you did not do finance courses previously outside of financial management, you may not have been exposed to the money market. All right? I know a couple of people would have done portfolio management, which would help them to understand that concept. So, Sean and not Jahim, did I see another hand that's doing management and finance? Okay. So, but I'm almost certain there are a couple more people who may not be here. If you have a difficulty understanding, please stop me. All right? Because, and this is the reason why financial management is a prerequisite for this course. Okay? Because it helps you to really understand better. All right. So you have the financial contracts, that's one way, and the financial contracts refer to your forwards, your futures, the money market instruments, option contracts, and swap contracts. We haven't spoken about swap contracts as yet. We'll speak about that a little later. Then you have operational techniques. All right? So your operational techniques refer to which invoice currency you choose to use. All right? So how are you going to invoice? So you're an American company, you're selling to a British company, you choose your invoice currency. Are you going to invoice in US or are you going to invoice in foreign currency? Now you might say, but why would they even invoice in the foreign currency? Anybody can think of why they would invoice in the foreign currency,
If they would,
although they're exposed
The less taxes.
to the taxes,
if they would gain from the foreign exchange,
if they will gain from the foreign exchange. Anybody else have a suggestion?
Less regulation, maybe? No, I think
It's actually a practical reason that they would invoice in the foreign currency. Now, when you have companies, manufacturing companies, that are bidding for contracts overseas, it's more attractive when you bid in the foreign currency. It's more attractive to the company that is requesting the bid.
Okay.
Okay? And so large manufacturers tend to bid in manufacturers, engineering companies, and so tend to bid in the foreign currency. Okay? Because it's more attractive. The other is lead and lag strategy. Lead and lag, we'll discuss that. That lead and lag speaks to when you bill immediately, you bill later, we will discuss those, and something called exposure netting. All right? Where you look at your receivables, you look at your payables, and you in foreign currency and you net them off. But we'll get into that. Any questions so far? All right, so why would they hedge? Quite apart from ensuring that you're reducing your exposure, there's some other practical reasons, right? Information asymmetry. So information, everybody doesn't have all of the same information at the same time. That is what is information asymmetry. So management becomes aware that the firm is exposed. They know what the exposure position is and they can manage that exposure. Just the fact that they know what it is, they can manage it. All right? And they can manage it because they may have a little bit more information than another company about the company that they're doing business with overseas. Then you have what we call differential transaction costs. So firms have lower transaction costs than individuals. 1 and 2, firms have at their disposal the hedging tools that are not available to individuals. So the average person wouldn't go out there to try to hedge their foreign currency transaction. So, so my children live in Canada, they go to university, and I am not going to go out there and hedge a transaction. So for example, I have an idea what the tuition is. I don't know how the Canadian dollar is going to be performing. But I'm not going to, what do I have available to me hedging opportunities? Not really. But companies have those opportunities. All right? For me to go and hedge to pay my children's tuition, first of all, I need to have the money. Right? I need to have the money now for September. Right? I may not have all that money now for September, so that alone eliminates the hedging, right? Okay? I need to have some at least to be able to do that transaction. Companies have resources at their disposal and opportunities to hedge more so than individuals. Default costs. If default cost is significant, you know what default cost is? If you default on a contract, all right, you made an agreement to provide X amount of goods to a counterpart. If the default cost is going to be high, you will hedge. All right? Darwin spoke about taxes. Progressive corporate taxes. Stable before tax earnings usually result in lower corporate taxes. So if you can stabilize your earnings by reducing your foreign exchange exposure, then the corporate tax will be lower for the firm. Right? So you don't know what your earnings will be per se because of foreign exchange fluctuations. But if you can reduce that foreign exchange exposure, right, where your earnings can be more, your earnings can end up being less if there's fluctuation. You can reduce your taxes using hedging. All right, we're not gonna get into that in any detail, but we're gonna focus more on how the businesses actually conduct their transactions, how they reduce the exposure. All right? So here's an example. Once you are, like I said before, once you are in business, once you're doing business outside of your country, outside of your currency area, you are going to be exposed to foreign exchange exposure on your payables and on your receivables. You know what payables are? When
Yes.
you owe, and your receivables are when somebody owes, right? So you're exposed to, a company is exposed to foreign exchange exposure either way, okay? So Boeing is like the favorite example used in the book. And that the Boeing example is, it's used in all of the different types of hedging, right? So Boeing is in the United States, right? Boeing manufactures landing gears. You know landing gears for a plane?
Yes.
Landing gears. The
Like
wheels.
the wheels, basically, yeah.
All right.
Control the wheels.
Okay, so they manufacture landing gears, but you have airlines all over the world. And we know that airlines all over the world, they purchase Boeing aircraft. They purchase from Boeing, they purchase from Airbus, all right? Engines come from another company, McDonnell Douglas, and so on, if you know about the aviation industry. So Boeing is exporting a landing gear. They exported a landing gear to British Airways, and they build British Airways in pounds. All right? So British Airways, they make the landing gear, and they build 10 million pounds. It's expensive. All right? And it's payable in 1 year. We have some information here because we have interest rate information and we have exchange rate information, because we are going to do two different types of hedging. All right? We're going to look at two different examples in hedging. So the US interest rate is 6.1% annually. The UK interest rate is 9%. The spot exchange rate, US 150 to the pound, all right? Forward exchange rate, US 146 to the pound, 1 year maturity. What is the transaction? So, it's a payable. Remember, British Airways is going to pay 1 year from now. They are going to be paying $10 million to Boeing. Boeing is in the United States. When Boeing gets that $10 million in a year, they need to convert it to US, right? Yeah? You know that you are doing this transaction. You know you have the $10 million payable. So because you have this information and you do not know what the sterling US rate is going to be 1 year from now, you can protect yourself. All right? So Boeing should consider hedging in the forward market. So in hedging the forward market, what Boeing is going to do is to sell its receivables forward, right? So Boeing will enter into a contract where it will sell 10 million pounds, all right, for delivery in 1 year, all right, for US dollars. So Boeing goes into a contract where Boeing is going to sell 10 million pounds to some counterparty, all right, in 1 year, because it knows that it's going to get in 1 year, okay? So what Boeing does is it's going to, you know, it's getting that 10 million US. Today, the spot exchange rate is 150 to the sterling. The forward rate is 146 to the sterling, right? So Boeing is going to protect itself because it doesn't know what the rate is going to be, okay? Because currently it gets 150 US for 1 sterling. In the future, it expects to get 146 US for 1 sterling. What if the US depreciates against the sterling in 1 year? So it's going to get, appreciates against the sterling in 1 year. It's going to get less US dollars for a sterling. All right? So it enters into a forward contract where when it gets that 10 million sterling, it's going to sell it for US dollars, right? So your gain or your loss is equal to your forward rate minus your spot rate, so F forward and ST spot, right? So this is all formula you need to know.
Okay.
All right? Times the foreign currency. Okay? So in this case, let's see what it is. So your forward rate, you remember what the forward rate was? 146 minus, what was the spot? How much of the foreign currency are you
10 million.
Okay? So do the working. So let me on the side. So you already know what the forward rate is, right? So it's 146 times the $10 million. So you're gonna get how much US? You're gonna get 14.6 million US. All right? But this is the formula for gain loss, okay?
Makes sense. For I'm putting 10 million. 4 million loss. 4 million loss, is it? What?
Okay, so
Oh.
if Boeing, so Boeing,
400,000.
Boeing is gonna get 14.6 million when it sells that forward contract, right? I put in the 150 there, that was the spot rate a year ago, okay? Now, what if the rate went higher? But what if the spot rate was not 150, but it was 152? What would be the gain or the loss for Boeing? So this is your spot rate. Let's put it in the future here, just so that we know. If the spot rate was 152 a year from now, what would be Boeing's gain or loss? Huh? 600,000. Okay. And is it a gain or loss? Loss. It's a loss. Okay. So it'll be a loss of 600,000. Okay. Now, if you don't know, it doesn't matter to Boeing what the spot rate is really, because Boeing would have already entered into the forward contract, right? For the 1.46. You're looking a little confused.
And then, okay, so when they enter into the contract for the 4 year, they get paid
They get paid at the year
at the
based
year.
on the forward contract, based on the rate that
Okay,
they negotiated.
okay.
Now, if they didn't negotiate that,
Mm-hmm.
then if the rate was 1.52, they'd have said that they incurred a loss.
Okay.
All right? To them, it doesn't matter because they already entered into the forward contract. All right? And you will see later on, probably not today, you'll see later on how if they entered into an option contract, for example, what would have happened?
You still don't-
Still don't get it?
No, it's just that those terms like still kind of foreign to me. Options.
Still foreign,
future-
options, futures.
and-
So you know, that means you have to go to
yeah,
your book
and read it and stuff.
and do your reading,
Right.
okay?
Mhm.
We'll do some examples,
Wishy-washy.
but I'm not gonna focus on that today,
Okay.
all right? We have to do some more examples. All right, so this is just a straight forward hedge, all right? You enter into a forward contract, and that's what you end up getting.
If the forward rate is always lower than the spot rate, would they always
Right, but you don't know what it's going to be. You don't know what the spot rate is going to be. So the spot rate could have been lower. If the spot rate were lower, then it would have been a gain. All right. So that's your forward hedge. Very straightforward.
So, so that means, in truth, they lose. So it would have been beneficial if they just exchange at that rate, but trying to, yeah, they don't know, but if that's the case that it happens frequently, wouldn't they look forward to just exchange it at the future rate? Something could happen.
Something could happen, you don't know. You know, that's the thing, you don't know what's going to happen. Because it's a whole year. It's a whole year. Look at COVID pandemic. What currencies would have suffered in COVID? That'd be interesting to go back and look, right? Look at the Russian-Ukraine war, all right? Just because if Ukraine was doing a lot of business outside, or US companies are doing business with Ukraine, then Ukraine exchange rate would have declined, right? And if you're doing business with them, you may benefit from that, but that depends on what side you're on. So if the US had company, if let's say the US build in Ukrainian currency, had a receivable coming in, what would have happened? So if Boeing sold a plane to a company in the an airline in the Ukraine, right? Then Boeing's receivable would end up being what? It would end up being less. All right? Okay. All right. So you're not going to get it right away. All right? You won't get it right away. You have to do some examples. Okay? For you to understand it a little better. Now, that's just a straightforward. You may not, right now, you may not see the value of it. All right? Because you're seeing it as Boeing having gone into a forward. Boeing didn't lose. You see Boeing going into a forward contract to protect itself.
So it gained.
But Miss,
It
they
gained.
didn't lose?
No.
No, because that's what they exchanged it at.
Okay.
And this was this, so if they didn't go into that contract, then it means they would have been getting less,
Okay.
less US dollars. All right? Than they
No, it's not.
would have.
It's just the words.
All right, so
It's the words.
okay. So now remember I gave you some interest rates. All right? Before?
Mhm.
Let me show you. Go back here. So the UK, US
6.10.
rates was
6.10
6.12%.
annually. UK 9%.
Rates 9%.
Spot
And
exchange rate.
spot
FX, exchange rate is 150 US for £1. Okay, and the
sorry, it's not the euro.
no pound.
It's the
So okay. Call it a pound sterling.
and the forward
Exchange rate is $146 slash a pound. $1.46.
okay, same rate. 1 year
Annually. Maturity.
Okay, so with a money market hedge, the company takes advantage of the difference in the exchange rates. All right? This
Okay.
one is a little bit more involved. Okay? So
Arbitrage.
with the money market hedge, you're going to hedge your exposure by lending and borrowing in the domestic and foreign currency markets, right? So when we look at the US interest rate is 6.1% and the UK rate is 9%, right? So what the company would do is either lend or borrow in the foreign currency to hedge its receivables, right? How does this happen? So what they do is they match their assets, okay, versus their receivable, their liabilities in the same currency. So when it has, all right, so when you have receivables or payables, you're gonna match your assets and your liabilities in the same currency. How does that work? All right? So Boeing could have used a money market hedge. Let's see how Boeing would do that. All right. So Boeing would borrow in pounds, all right? They would borrow pounds. Then when they get the monies, they're going to convert them to dollars. And invest in the dollar rates. When they get the monies, the 10 million in a year, 10 million pounds, they are going to pay off the loan, the pound loan. Remember, they borrowed in pounds, right? So how much pounds do they need to borrow? That's the first thing they need to figure out. All right? How much they need to borrow will be the value, should be the same as the receivable value. Right? So they're gonna borrow not 10 million, and this is where it becomes a little, I'm not gonna call it tricky, but you have to remember, okay? They need 10 million in the future, all right? So today, they're going to borrow the present value of 10 million pounds. So they're not borrowing 10 million, they're borrowing the present value of the 10 million, but they need the 10 million a year from now, all right? Let that sink in for a moment. See how it plays out. I know it may sound like Greek right now, all right? And I know you may ask yourself, why are they going through all of that? Protect themselves, all right? So, the first step, you have to determine how much pounds to borrow, right?
Okay.
You know you're going to need 10 million in a year to pay back that loan. So you're going to borrow the present value of 10 million. All right? What's the present value of 10 million? You borrowed it in UK. So the present value of the 10 million is going to be 10 million divided by 1.09.
06.
6, not 9. I'm saying 9 and writing 6. What's the price? So, y'all understand why you need financial management for this, because you need to know how to work out present value. Yes, Evan?
Yeah.
All right. And those, well, Richard did that already. Okay, so What is that amount? Work it out. Don't just depend on the screen because you see it